introduce our guest of honor, Tiff Macklem, Governor of the Bank of Canada. By way of background, Governor Macklem was appointed Governor of the Bank of Canada on June 3rd, 2020 for a 7-year term. As Governor, he is also Chair of the Board of Directors of the Bank and a member of the Board of Directors of the Bank for International Settlements. He is Chair of the Group of Governors and Head of Supervision and the oversight body of the Basel Committee on Banking Supervision, and co-chair of the Financial Stability Board's Regional Consultative Group for the Americas. While he has spent much of his career occupying increasingly senior positions at the bank, he's also had experience at the Department of Finance, where he was Associate Deputy Minister during the 2008 to 2009 global financial crisis. Before becoming governor, he was Dean of the Rotman School of Management at the University of Toronto, and prior to that, he served as director at Scotiabank. Governor Macklem was born in Montreal, Quebec, and is an economics graduate from Queen's and has a master's and PhD in economics from Western. This is quite the resume. And if it appears like I'm smiling, ear to ear or gushing a little bit, it's because I'm a little bit starstruck. It's, because, as someone who has spent the majority of her career anticipating, trading around, and even advising clients on central bank movements, Governor Macklem is considered a bit of a celebrity in the central banking circles. I digress. As Governor Macklem said last week in his most recent fixed announcement date, the bank lowered its policy interest rate by 25 basis points to 4.25% to reflect 3 key considerations. First, headline and core inflation have continued to ease as expected. Second, as inflation gets closer to target, we want to see economic growth pick up to absorb the slack in the economy, so inflation returns sustainably to the 2% target. Since the July monetary policy report, the upward forces coming from prices for shelter and some other services have eased slightly. At the same time, the downward pressure coming from excess supply in the economy remains. If inflation continues to ease broadly in line with our July forecast, it is reasonable to expect further cuts in our policy rate. We will continue to assess the opposing forces on inflation and take our monetary policy decisions one at a time. I would say that in central bank parlance, the bank can probably afford to do a little bit of a victory lap, especially for its prescience, in light of the most recent employment data that was released only a couple days later. I know that's not what today's speech is about, but I just wanted to flag that for everybody. So today, Governor Macklem will speak about shifts in global trade and investment from a Canadian perspective. The floor is over to you, Governor Macklem.
Well, thank you, Sharon, for that lovely introduction. And I think we're done on monetary policy. Beautifully done. The last time a Bank of Canada governor spoke to the Canada-UK Chamber of Commerce, it was 2018. And my predecessor, Stephen Pola, spoke to you about low global interest rates, the steady reduction in inflation risks, and the successful conclusion of the North American trade negotiations. Brexit was in motion, but was not yet a reality. How the world has changed in just 6 years. The pandemic, Russia's unprovoked invasion of Ukraine, and a global battle against inflation have altered the economic landscape. Concerns about national and economic security are changing trade, investment, and business decisions. Accelerating digitalization, particularly AI, is creating new competition for economic power. Geopolitical tensions are shifting economic relationships, and industrial policy is making a comeback. In my time with you today, I'm going to talk about how trade is changing in response to these forces, both globally and for Canada. I'm also going to discuss what international financial institutions and the Bank of Canada can do to safeguard stability and prosperity as the global economy shifts beneath our feet. While there are many uncertainties, one thing looks clear. International trade will be different in the years ahead. Canada needs to be ready for the opportunities and for the disruptions. As World War II was ending, Allied nations created the Bretton Woods institutions, the IMF, the World Bank, and what would eventually become the WTO. They wanted to avoid the protectionism and instability of the Great Depression. And they believed economic cooperation, including open trade, was the best way to sustain peace and prosperity. For roughly the next 65 years, rising global trade and economic growth have gone hand in hand. Open trade brought specialization, innovation, and economies of scale. It drove investment, efficiency, and productivity. For consumers, open trade increased the selection of goods and services, and it lowered prices. Trade spurred income growth across countries, lowered global poverty, and raised standards of living. Trade grew faster than GDP until about the global financial crisis in 2008-9. Now, some think we've entered a period of deglobalization. Others see it as a slowdown in globalization or a slowbalization. The enormous disruptions caused by the pandemic make the recent trend hard to discern. But there is no question that global trade growth has at least slowed. That's a big concern, especially if you're an open economy like Canada or the United Kingdom. To some extent, a slowdown in global trade growth was inevitable. Once tariffs were substantially reduced and most economies were participating in global markets, the potential to expand trade by lowering tariffs further and including more countries became more limited. But recent events have exacerbated this slowdown. New global tensions have added trade frictions between competing countries. Public and political support for open trade is also waning, in part because the benefits have not been evenly shared. We've all benefited from a wider selection of goods and services at lower prices. But when low-cost importers undercut domestic producers, workers who lost their jobs lost more than they gained. With changing economics, new security threats, and waning support, global trade is being rewired, recast, and redirected. Trade is being rewired by shifting international economics. China is no longer the lowest cost global supplier of consumer goods. Production of many manufactured goods is moving elsewhere. As China moves up the value chain, it's competing more directly with advanced economies. At the same time, the pandemic, Russia's invasion of Ukraine, geopolitical conflict, and climate change have all made supply chain resilience a greater priority, even at the cost of efficiency. Trade policy is being recast to encompass national and economic security and to foster leadership in strategically important industries. Trade and industrial policy are being used to make the supply of critical inputs more secure and protect and promote domestic production in key industries. Globally, trade is being redirected by import and export restrictions, tariffs, and conflict. Trade in high-tech is constricted by geopolitical concerns. The shift to cleaner growth is accelerating trade restrictions on raw materials needed for green energy. Climate change and conflicts threaten food security, promoting export restrictions on key staples. And Russia's invasion of Ukraine has led to a multilateral expansion of the scope and reach of economic sanctions. How does an open economy like Canada's best navigate this changing trade landscape? Well, that's a very big question. So what I'm going to try and do is break it down into some manageable bites. I'll start with 3 global trends, which I want to highlight. First, global trade growth has slowed, and this slowdown is concentrated in advanced economies. Second, the growth we are seeing in trade is shifting from goods to services. And third, trade is fragmenting as China's role changes. In sum, trade routes and trade partners are shifting, and the implications for our prosperity could be significant. So let me take each of these in turn. First, trade growth in advanced economies has slowed in the last decade, and this has pulled down global trade growth. But trade by and between emerging and developing countries has continued to grow. Indeed, WTO Director General Ngozi Okonjo-Iweala believes trade has entered a new, more inclusive phase, which she calls reglobalization. Over 25 years, the share of global trade among developed countries has declined, while the share among developing countries has more than doubled. As Dr. Okonjo-Iweala has stressed, preserving open trade is critical to raising incomes in developing economies and narrowing the gap with more advanced countries. The second trend is that trade in services is picking up even as trade in goods is slowing. Globally, goods trade is a much bigger piece of the pie. It's more than 3 times larger than trade in services. So strong growth in services doesn't fully offset weak growth in goods. But trade in services is gaining share. Since about 2000, growth in services trade has outpaced goods, though the impact of the pandemic has impacted both. Global demand for goods soared early in the pandemic when we were all stuck at home. Then when our economies reopened, consumers turned to services, particularly the ones we'd all missed during lockdowns. But the pandemic may have also provided a more durable boost to trade and services. Because customers had to be delivered digitally during lockdowns, business invested in digital delivery, adding supply along with demand. Increasingly, exporters deliver services through computer networks, via the internet, apps, emails, voicemails, video calls, and intermediation platforms. Trade volumes for commercial services have risen about 20% since 2019, sharply as have financial and trade services. And digitalization continues, especially the opportunities created by AI to create new services and change the way services are delivered. Now, whether growth in services trade will continue at this rapid pace is an open question, but the seemingly vast potential of digitalization suggests that future growth in trade will be tilted to services. The final global trend is the shift in global relationships. China is a big part of that story. Its exports have moved up the global value chain, and geopolitical tensions are altering key relationships. Rising wages, increased expertise, and deliberate government policy have all pushed China into higher tech electronics and advanced products. China is now the world's biggest exporter of broadcasting equipment, computers, solar power, and electric batteries. Its electric vehicle industry is the largest in the world, with over half of global production. These advances have sparked concern that Chinese technology could both displace local industry and compromise national and economic security. The US has banned the use of some Chinese products and restricted the exports of leading technologies to China. Other countries, including Canada and the UK, have taken similar steps. In May, the United States announced it would quadruple its tariffs on Chinese EVs to 100%, and Canada is following suit. The EU is also applying higher tariffs on EVs. But the increased use of trade restrictions is actually much broader than China. Trade restrictions increased sharply around the world starting in about 2018. So did industrial policy to bolster domestic players against imports and respond to security concerns. Security risks are real and they need to be addressed, but it is important that they do not become a pretext for inefficient protectionism. Trade is also being rerouted as businesses try to diversify supply chains and find friendlier partnerships. But the combination of more trade restrictions and shifting trade routes means supply chains have actually gotten longer, with products detouring through other countries such as Vietnam instead of going directly from China to the United States. Fragmentation has economic costs. Businesses have to focus on national security and geopolitical uncertainties, not just efficiencies and productive partnerships. The IMF estimates that the costs of trade fragmentation could range from 0.2% to 7% of global GDP. But costs go beyond trade, and the losses are unlikely to be evenly distributed. The loss of knowledge spillovers, high-tech partnerships, critical imports, and capital flows affect low-income countries in particular. The potential for trade and innovation to continue to lower global poverty will decline. So those are the global trends. In many ways, Canada is a microcosm of these global shifts. Our overall trade growth has slowed in recent years. Our export growth has been coming increasingly from services, and global fragmentation is presenting new challenges and opportunities. Canada is a very open economy. Over the last decade, trade as a share of GDP has been about 2/3, the second highest in the G7 and the fourth highest in the G20. We rely on exports for roughly 1/3 of our income. Imported components feed our industry, and imported final goods and services improve the lives of Canadians. The U.S. is by far Canada's biggest trading partner, accounting for roughly 75% of Canada's exports. Thanks in part to the Canada-U.S. Free Trade Agreement signed came into force in 1989, and updates in the years following, Canada and the U.S. benefit from the largest bilateral trade relationship in the world. Our biggest exports to the United States are oil and gas and motor vehicles and parts. But our trade agreements go well beyond the U.S. In total, Canada has 15 trade agreements covering about 2/3 of world GDP. Together, these agreements cover 1.5 billion consumers worldwide. But even with this broad market access, growth in Canada's exports has slowed over the past 10 years. The pandemic obscures the overall trend, but it's clear that goods exports have not kept up with economic growth in Canada's two biggest markets, the United States and the European Union. The slowdown is fairly widespread. Production and exports of machinery and equipment, motor vehicles, and other non-energy goods have not expanded in more than a decade. Now, just as we've seen globally, where we have seen growth in Canada's trade is in our exports of services. As good growth began to stall around the time of the global financial crisis, growth in services exports picked up. As in other countries, digital delivery has helped drive Canada's service exports, particularly computer, management and financial services, as well as research and development. That plays to Canada's strengths, including our highly educated workforce. Since 2019, real exports of commercial services have grown 17%, adding more than $15 billion to real GDP in Canada. Canada is somewhat insulated from the third global trend, fragmentation, because so much of our trade is with the United States. But shifting supply chains present risks as well as opportunities for Canadian business. At the start of the millennium, Canada had the biggest share of U.S. goods imports at about 20%. By 2017, China had the largest share, and Canada had fallen to third place. As the U.S. finds new partners to supply goods it once got from Canada is starting to reassert itself. In the first quarter of 2024, Canada was the second largest source of U.S. goods imports after Mexico, and exports were ticking up. That brings me to the challenges ahead. The trade landscape is shifting. So how should Canada respond? I see three key elements. We need to seize opportunities to secure our place in a rewired trade system. We need to be effective at the international table to influence how trade is recast and redirected. And we need to manage the shocks that are bound to come. Fortunately, geography and history have given Canada significant advantages in global trade. With the Canada-US-Mexico agreement, we have a strong relationship with the biggest, richest market in the world, which sits right next door to us. Despite the shifting trade winds, 77% of Canada goods exports still flow to the US. And Canada is also the #1 export destination for the US and the largest destination partner for 32 of its 50 states. The continued success of this trade relationship is in the interest of both countries. Beyond the US, Canada has strong market access around the world thanks to the trade agreements I've already mentioned. But holding our ground is not going to be enough. We need to build better relationships, produce the products people want to buy, build and maintain the infrastructure to get those products to market, and boost our productivity to compete globally. The Canada-UK relationship is an important one. UK is Canada's third largest trading partner, and with two-way trade of more than $50 billion. We've made progress towards a bilateral trade agreement, but sticking points remain. And until they're resolved, too many goods and services will remain outside the competitive tariff-free supply chains we've established with other countries. There are benefits to getting this done for both our countries. Canada needs to be able to sell the products people want to buy. We are a stable, responsible, technologically advanced energy producer. Our auto sector is globally competitive. And we have new and emerging areas of strength, including green technology and electricity. To leverage these strengths, we need to invest in trade infrastructure and reduce trade barriers so that integrating Canada into the North American value chain is more attractive for business. This includes investing in our electricity grid and transportation infrastructure. And business needs to invest in new equipment and innovation to be globally competitive. As trade is recast for security or strategic reasons, Canada is a trusted and reliable trading partner. Canada is not going to be the cheapest alternative, but we have a highly skilled labor force, reliable energy and transportation networks, and solid financial institutions. Moreover, Canada has a stable democracy and strong rule of law, and we provide a reliable and important voice at the global table. That brings me to the second priority. We need to invest in effective multilateral institutions. They are more important than ever in this fragmented world, and they're only going to be as effective as members want them to be. It has never been easy to attain international cooperation, and open trade has come under particular pressure. But the trends I've just outlined increase the urgency. Our common interest is shared prosperity. We all benefit from a stable, open, rules-based global order. We need to build it, protect it, and adapt it to ensure the benefits are shared. Effective and legitimate multilateral institutions don't just happen. They need good governance, adequate resources, talent, and inspired management. Canada has long invested in the Bretton Woods institutions. We have a strong voice at the IMF and the Financial Stability Board. We know the value of an effective WTO that can serve as a forum for negotiations, act as an arbitrator of disputes, and monitor implementation of trade agreements. As Canada assumes the G7 presidency in 2025, we have a responsibility to lead difficult discussions. That includes trade, global financial stability, and mitigating climate change. As central bankers, our particular focus is the IMF, the FSB, and the international monetary order. We need to be sure that the international monetary and financial system is up to the task and is integrated with the other parts. The fundamentals of economics have not changed, but the need for resilience and agility has increased with changing economic circumstances. Finally, Canada needs to be ready for the trade disruptions that seem inevitable amid a changing trade landscape. The Bank of Canada doesn't set trade policy, but we need to understand shifts in global trade because they affect lives and livelihoods, and they drive costs and inflation. So let me conclude with the implications for monetary policy. The rapid globalization through the 1990s to around the global financial crisis significantly reduced the prices of many globally traded goods. This contributed to a lower cost of living for many households. Going forward, with globalization slowing, the cost of global goods may not decline to the same degree. And all things equal, this could put more upward pressure on inflation. Trade disruptions may also increase the variability of inflation. The pandemic taught us a lot about supply shocks and how they can affect the volatility of prices. Supply chains are complicated, and shocks affect inputs and outputs in different ways. And while supply shocks are historically transitory, they can persist and they can accumulate. We also learned that when the economy is overheated, disruption to supply can have an outsized effect on inflation. So what is the Bank of Canada doing to ensure we're prepared for the supply shocks that come with trade disruptions? Well, we're investing in data and analysis to better understand supply chains, especially at the global level. We're updating our models to use scenarios when periods of uncertainty make central forecasts less reliable. And we're using more microdata to track and understand the consequences of trade and industrial policy. But even with a better understanding and better information, trade disruptions may mean larger deviations of inflation from the 2% target. Supply shocks present central banks with a difficult trade-off. Monetary policy can't stabilize growth and inflation at the same time. That means we have to focus on risk management, balancing the upside risk to inflation and the downside risk to economic growth. Most importantly, we must avoid adding uncertainty to an already uncertain environment. That means ensuring inflation is low, stable, and predictable, even as global trade is being rewired, recast, and redirected. Thank you very much.
So thank you very much, Governor Macklem, for sharing your insights on really what is a complex subject. We are now going to proceed to the question and answer session of our luncheon, and I'm told we've got a tight 10 minutes for this. Before I open the floor to questions, I actually have a couple questions myself. You spoke about trade barriers, and I want to link this back to your mandate. You spoke about the impact of trade barriers, but can we peel back the onion a little bit and think about what is the framework or approach that the bank uses in analyzing the impact to inflation from these global shifts in protectionist policies?
I think hopefully that works well. Well, as I really tried to outline in my remarks, the trade landscape is shifting. There's a lot of uncertainty, but there are some things we can see. Businesses are investing a lot in the resiliency of supply chains. That's going to have some cost. Businesses also need to think more about security. They need to manage geopolitical uncertainties. They can't think purely about the efficiency. Again, those security threats are real. They've got to be addressed, but that will come with some cost. So, we have a clear mandate. We have an inflation control. We are charged with maintaining low and stable inflation. For us, we need to understand what are the cost implications, and then what happens to those costs? Do they eat into profit margins? Do they get passed through into final goods and services prices and put upward pressure on inflation? The other element is if you've got more trade disruptions, you could see more volatility in prices, more fluctuations in inflation. And particularly given these are supply shocks, as I was just saying, when you have a demand shock, demand is weak, economy is weak, inflation tends to go down. We lower interest rates, that stabilizes the economy, brings inflation back. Supply shocks are much tougher. Output goes down, unemployment goes up, at the same time inflation goes up. So you've got to do your best to assess how persistent is this supply shock. Can I look through it? Do I need to take some action? What's happening to expected inflation? I mean, the one thing we know is if we don't keep inflation expectations well anchored, nothing in the economy is going to work well. So, as I said, I mean, we're trying to get better micro data, a better understanding of global supply chains, so that we can do the best we can to manage the realities that we're going to have to face.
And certainly topical, given we're in an election cycle around the world, it seems. I'm going to shift a little bit because you talked about employment just now. In the most recent mandate renewal, the bank pledged to use the flexibility in the inflation mandate to pursue employment goals. How do you think about the trade-off in unemployment versus inflation in the current environment, given the progress that has been made on inflation? And also given that the spikes in both prices and employment were really what I see as exogenous shocks on the back of a pandemic.
Sure. Well, let me make 2 points there. First of all, so in Canada, the Bank of Canada's monetary policy framework is agreed with the government, and that happens every 5 years. And the last agreement was in 2021. And the Bank of Canada and the government agreed that the best contribution monetary policy could make to the well-being of Canadians would be to continue to focus on price stability. It also was clear that we should continue to do what we can to support maximum sustainable employment. But at the same time, it was clear that the primary objective is to maintain low, stable, and predictable inflation. So, like the Bank of England, Canada has an inflation target. So when you look at where we are, a year and a half to 2 years ago, the labor market was very overheated. Businesses couldn't hire all the workers they needed. They couldn't produce all the goods and services people wanted to buy. Inflation was very high. Since then, inflation has come a long way down towards the inflation target. Our last reading, 2.5%. And we think there's going to be further declines, further easing in inflation going forward. The labor market, which was very overheated, came into balance. And in the last number of months, slack has been developing in the labor market. Where you see that, so there haven't been large, unusual numbers of layoffs. Layoffs have been fairly normal, but employment growth, hiring has been weak, and it's been below the rate of labor force growth, population growth. So what that means is that new entrants into the labor market, it's taking them longer to find a job, and that is, their unemployment rates have gone up. So youth and newcomers to Canada, we have high rates of immigration, and that is being reflected in the overall unemployment rate. So we now have some slack in the labor market. With inflation getting closer to target, we want to see growth pick up. We want to see consumer spending strengthen. We want to see business invest. We want to see job growth pick up so that we start to take up the slack in the economy. So as inflation comes down to the 2% target, it settles close to 2%. We don't want to see if the labor market's weak, there are missing jobs, missing incomes. It's not good for Canadians. It also means inflation could go below the target. So we want to see that pick up, and that has fed into our monetary policy decisions. As you outlined, we've cut our policy rate now 3 times to 4.25.
With that, I think we've got time for a question from the audience. So I'm going to go straight to the front row.
Hi. So building on the last point, obviously in the latest unemployment report, we went up 20 basis points again. I wanted to ask you, how much further loosening do you think there needs to be before, the downside risks are really sort of building and you may have to speed up the pace that you're getting to neutral at? We've seen this with the Fed, that, no more loosening is welcome, and there is the potential to speed up the pace to getting to neutral. As you said, the inflation prints have got much better. Your six-month measures are all running around 1%. At what stage does you have enough confidence to speed up the pace you get back to neutral?
Well, we're of course asking ourselves those very same questions. So yes, we got another employment number last Friday, just after our last decision. There was very modest growth in employment. In many respects, it follows the pattern we've seen now for a number of months. Employment growth is fairly weak, and it's certainly well below growth in labor force. Going forward, I think we've been pretty clear, as you outlined off the top. We expect inflation is going to continue to ease. We want to see growth pick up, and against that background, it's reasonable to expect further cuts in our policy interest rate if the economy continues to evolve as we're expecting. Now, as you look forward, the other thing we've been clear about is we're not on a predetermined path. We're going to take these decisions one at a time based on the best available information at that time. And when you look forward, there are a few scenarios you can imagine. It could be that inflation's at 2.5%. We expect it to keep easing. Actually, as you get towards the end of the year and early next year, given some base year effects, it'll probably bump up a little bit. There are risks. We've still got wage growth running well above productivity. There is a risk that feeds into labor-intensive services, and you don't see as much easing in inflation as we're expecting. As we lower interest rates, the housing market could strengthen more quickly than we expect. That could put we've already got very high shelter price inflation. That's the main thing holding inflation up. So there are some upside risks, and we got to keep those in mind. And if those were to materialize, it'd probably be appropriate to slow the pace of further interest rate cuts. On the other hand, picking up on what you said, yes, we want to see growth pick up, and in fact, growth in the first half of the year was actually did pick up. It was roughly 0 second half of last year. It's roughly 2% in the first half of this year. So we're pleased to see that strengthening. Our July forecast was we would see further strengthening going forward. There is some downside risk to that. Some of the latest indicators, monthly GDP in particular, have been weaker. Employment growth has been weak. So there is some downside risk to that. And if that risk were to materialize, if the economy was significantly weaker than we expect, if inflation's weaker than we expect, yes, it could be appropriate to lower rates more quickly. As I said, we're going to be taking those decisions one at a time and making that assessment at each decision.
Thank you.
Do we have time for another question? I'm looking at my handlers. One more question. I see one hand there. We'll wait for the microphone to get to you.
First of all, Governor Macklem, thank you so much. Always a pleasure to hear you talk. It's interesting to have you mention the important trading partners. So to that extent, how much do you consider what Powell, Bailey, Lagarde are saying about their ongoing monetary policy? And to phrase differently, does that actually impact your thought process in deciding whether or not you cut the rates and by how much?
Well, let me make 2 points there. The first of all, particularly through the pandemic. We were all hit with the pandemic at the same time. We all experienced a sharp rise in inflation coming out of the pandemic. We've all raised interest rates forcefully. We've all brought inflation back down, and we're all now trying to stick that soft landing. So, broad brush, we have a lot in common. And one of the great things about the central bank community is that we meet and talk to each other regularly. In fact, I was just in Basel over the weekend, where the governors of the central banks were together, and it is really valuable to share perspectives, to see how my counterparts see what's going on in their economy, what are they focused on, what are they thinking on. That is really helpful, I think, to all of us. At the same time, our mandates are all very clear. We take our decisions in the best interests of the citizens of each of our countries, and we have flexible exchange rates so we can do that. Obviously, for us, we are most integrated with the United States. The U.S. is the biggest financial market in the world, and what happens in the United States has a big impact on Canada, and that's certainly something we take into account. But at the end of the day, we take our interest rate decisions in the best interests of Canadians based on what the Canadian economy needs. And you can see that there have been some differences. So in Canada, we started cutting our policy rate in June. We've cut it 3 times now. The Fed has yet to cut. So there has been some divergence between us has opened up. I think going forward, given that markets are increasingly convinced the Fed will pivot to an easing cycle, that divergence is becoming less of a story. And we have seen some movements in our exchange rate, but actually, that's what the exchange rate is for. It's there to absorb those differences, and they've not been very large.
Well, with that, I'd like to thank you very much for your speech and this luncheon.
Well, thank you. A great pleasure to be in London. Thank you.
Good afternoon, everyone. My name is Nicholas Galetti, Bank of Canada Communications, and I'll be moderating this press conference. Thank you for Governor Macklem for being here. He'll be pleased to take your questions for about 25 minutes. Before you ask your question, please state your name and affiliation. We're webcasting this press conference, so please use the microphone that will be handed out in the room, and raise your hand when you're ready. We also have journalists participating remotely today, so we'll do one question in the room and then turn to the call and see if we can get every news organization into the press conference. Le gouverneur est prêt à répondre à des questions en anglais ou en français. Donc, s'il y a quelqu'un en ligne en français, n'hésitez pas. Libre de vous à poser la question dans la langue de votre choix. So, first question over here.
Hi there, Paul Weldy from the Globe and Mail. You talked a lot about in your speech about Canada's reliance on the U.S. for trade. Do you worry about somebody like Donald Trump winning the election, given the high tariff agenda he's pursuing in this campaign, more so than even when he was president?
Well, you won't be surprised. I'm not gonna comment on politics or any party or any administration. But look, the Canada-U.S. trade relationship is very valuable to both our countries. It has, been periodically renegotiated, updated, expanded, and I think continuing that strong relationship is going to be very important for Canada. And yes, anything that were to disturb that, that could have a significant effect on the Canadian economy. As I said, this has been a very durable relationship. It's very much in the interest of both countries, and I think both countries will want to see it continue.
Hi, Sue Chan from The Telegraph. Just a follow-up question from some comments that you made in your speech on China. How do you think the West's approach to Chinese EVs will impact the transition to net zero, given the concerns around the costs of that transition? And do you agree with the West's approach to China, particularly on electric cars?
Well, look, at the Bank of Canada, we don't do trade policy, we don't do climate policy, we do monetary policy. So, I mean, what we're really focused on is what I talked about in my remarks. Look, the global trade order is shifting. The relationship of the West with China is clearly shifting. You look at imports into the United States. China's share has come down significantly. Look, that shifting global order, it does have cost implications. I think the IMF in particular has done some very good work on the potential costs of trade fragmentation. We'll see what happens, but our job is to control inflation, and so what we're focused on really is, where are those costs? Where are they in the system? What's going to happen to those costs? What impact are they going to have on the economy? What impact are they going to have on inflation? So the changing relationship with China is a big part of that story. And our job really at the Bank of Canada is to understand how that's impacting the economy. It's not our job to set policy, climate policy or trade policy.
Irina Angel from Bloomberg. Governor, Friday data showed Canada's unemployment rate unexpectedly jumped to 6.6% in August. Are you expecting layoffs to ramp up in the coming months?
Well, first of all, I mean, Friday's number, as I just mentioned, it really continued what we've seen now for a number of months. Employment growth. Employment, it's not negative. There's modest positive employment growth, but it is well below growth in the working age population. What you're seeing is that, yes, businesses are hiring, but they're hiring much more slowly than people are entering the labor force. So that's particularly impacting younger workers or graduating from school. They're looking for that first job. It's taking them longer to get that first job. So you're seeing youth unemployment has gone up a lot. We also have very high rates of immigration. The government is planning to reduce that. It will be coming down, but over the course of this year so far, it's still been strong. And newcomers to Canada it is also taking them longer to find a job. So you're seeing their unemployment rates go up. So that's really being reflected in the overall unemployment rate. To this point, we haven't seen a big change in layoffs. If you were to see that, that would certainly be a concern. As we've been very clear, we've lowered interest rates 3 times now. If the economy continues to evolve as we're expecting, it is reasonable to expect further cuts in our policy rate. And one of the reasons why we've been lowering rates is, as inflation gets closer to our target, we want to see growth start to pick up. We want to see households spending increase. We want to see business investment increase. We want to see companies hiring, have bigger hiring plans. We want to see job growth pick up. There'll probably be some lag. The labor market often lags a bit, so there's probably, you're probably going to see some further adjustment in the labor market. But we do want to see job growth pick up going forward, and that's certainly something that's factoring into our interest rate decisions.
Hi, it's Sophie Ng, Politico. UK-Canada free trade negotiations broke down earlier this year. Are you hopeful that they will restart again? Would you like to see them restart again under the new Labour government here in the UK? And what are the sticking points that you mentioned in your speech? Thank you.
Yeah, as I said, look, we don't do trade policy at the Bank of Canada. We're not at the trade negotiation table. I really wanted to use the Canada-UK relationship, though, as an example of the kind of, smart regional trade agreements. The multilateral system has really stalled. It's going to be very hard to make progress at a multilateral level. That doesn't mean that like-minded countries, trusted partners, can't make smart regional trade agreements that would be in the benefits of both. So yes, there are some sticking points. I think this is an example of, we have a long history, we have a lot of shared interest. I think this is the example of a potential smart regional trade agreement.
Governor, hi. Les Commons from Market News. The Bank of Canada was certainly to the fore in the tightening cycle from 2-3 years back and has been one of the leaders in the latest easing cycle. What do you think, or what do you feel has given Canada, or the Bank of Canada in particular, an insight to be a leader in the inflation look? And what do you think, or what is your biggest fear to throw you off the easing cycle for the inflation rates? Thank you.
Well, I'm not sure I can really comment on the fact that we've been out in front. What I can say is, particularly, we obviously look very closely at the U.S. economy. So, and when you compare Canada and the United States, we both raised rates very forcefully. In Canada, inflation wasn't quite as high as the United States at the peak. We didn't raise our policy rate quite as high as they did in the United States. And we've obviously been cutting now since June. We have cut 3 times. The Fed has yet to cut. Why have we moved, and why does that probably make sense relative to where the Fed is? I think monetary policy in Canada has probably had more traction than it has in the United States. The structure of our mortgage markets is quite different. Your typical mortgage in the United States is 30 years. Canada, we have some variable rate. We have many at 5 years. So in Canada already, a little more than half of our mortgages have reset at higher rates. So, if you're a new home buyer, the situation in Canada and the United States is pretty similar. You're facing higher mortgage rates than you would have in 2020, 2021. But for households that have a mortgage, in Canada, more of those mortgages are reset. So Canadian consumers have less money to spend on everything else because they're spending more to service their mortgage. And the result of that is consumption has weakened more in Canada than the United States. And our economy has slowed more quickly than the United States. Inflation has come down a little more quickly. And I think that is reflected in the fact that we've started to lower interest rates before the United States. Risks. You want to? Well, look. We've been pretty clear. If things continue to evolve as we expect, it's reasonable to expect further cuts in our policy interest rate. We're going to be taking it one meeting at a time. We're not on a predetermined path, and that really reflects the fact that yes, there are risks. If inflation proves to be stickier, it may be appropriate to slow the pace. Wage growth is still running well above productivity growth. If we do expect, we've got some slack in the labor market, we do expect wage growth to come more in line with productivity growth. But, if that doesn't happen and that passes through to labor-intensive services, inflation could be stickier than we think. Housing market, as we've lowered rates, housing market could pick up stronger than we're expecting. Those are some of the upside risks, and if those were to materialize, it could be appropriate to slow the pace of interest rate declines. On the downside, as I've mentioned a couple of times, we want to see growth pick up. We want to see consumer spending strengthen. We want to see a job growth pick up. Some of the latest data, particularly the monthly real GDP, the labor market data has been on the weak side. that means there is some downside risk to that pickup, and that's something we'll be looking at closely. If the economy is materially weaker than we're expecting, inflation's weaker than we're expecting, it could be appropriate to take a bigger step.
Thank you. We'll go to the phone now. We've got a few people online. If I can just remind people on the call to mute their line if they're not asking a question. When I call your name, you can unmute and then mute again. And we'll start with Promit from Reuters.
Good morning, Governor. This is Promit Mukherjee from Reuters in Canada. This is a little crystal ball gazing question. I mean, we all know that unemployment in Canada is rising, especially because of increase in population. But with population expected to fall sharply, especially led by the government programs, do you think that unemployment in the country will also fall as sharply as it has risen? And if that is so, what implications will that have for inflation?
Well, just to be clear, I don't think population is going to fall. I think the growth rate of the population is going to come down. But yes, as you indicated, we do have very high rates of. We've had very high rates of population growth, and they've remained high so far through this year. When our labor market was really overheated, high rates of population growth, immigration, more non-permanent residents coming to Canada, that actually helped ease some of the pressures we saw in the labor market. But as the economy has slowed and hiring has slowed, it is taking longer now for those new entrants to Canada, those newcomers to Canada, to find a job. Going forward, and that is contributing to the rising rate of unemployment in Canada. If as the government has been very clear, their plan is to reduce the number of non-permanent residents coming into Canada, and that should, particularly if the economy is picking up and new entrants are coming in, yes, that should help pick up some of the slack in the labor market. Predicting precisely the timing of that is difficult, but that is certainly something that we're going to be watching closely.
Thank you. Next question to Jordan Gowling of the Financial Post.
Hi, Governor. Thanks for taking our questions. I just wanted to follow up on something you said in your speech in relation to what Canada can do to respond to the challenging trade environment. You said, quote, Canada needs to reduce trade barriers so that integrating Canada into the North American value chain is more attractive for businesses. What specific trade barriers are you referring to in this case?
Well, look, there's a few things there. One of the places to start is we still have too many barriers between provinces. Some of these are actual trade barriers. Others are more professional qualifications, and having a more seamless, more open interprovincial relationships would be a good place to start. The other thing I mentioned was we need to make sure we've got the infrastructure to get products to market. That includes getting products to our ports. That includes port capacity. It's rail. It's trucking. It's north-south. It's east-west. So part of it is making sure we've got the new products and new services that people want to buy, and then the other part, in the case of goods, is making sure we can get them to market.
Thank you. Next, Paul Vieira from the Wall Street Journal.
Governor, I know that the Bank of Canada has forecast 2.8% growth in the third quarter. Few private sector economists believe that growth is going to even come close to that. They're more believing growth of around 1%. How big a miss on second half growth or even third quarter growth would there have to be to consider a deeper rate cut of a half point?
Paul, well, you won't be surprised. I'm not going to put a number on that. You got to look at the number. You got to look underneath the number and see, where's the momentum, where's it coming from, how sustainable it is. So I really can't put a number on it. As I have indicated, there is some downside. With the real GDP through the second quarter weakening over the monthly profile, the flash estimate. Going forward, the weakness we've seen in employment in the last number of months, there is some downside risk to that Q3 number, where we will have a new forecast coming out. I think it's October 23rd with our monetary policy report. So we can dig into that more at that time. At this decision, we don't have a new forecast, but as I said, the second quarter itself was actually slightly stronger than we expected, but the monthly profile is weaker. So that is certainly something we'll be keeping a close eye on. We've got a whole range of, we've got some more labor force numbers to come out. We'll have some retail trade numbers. So we'll have a better fix as we get into October into what the momentum is looking like.
Thank you. We have just a couple minutes, so maybe one or two questions from the room. Sophie?
Thank you very much. I just wondered if you had met any UK members of the UK government or any officials during your time here, and if there had been any mention of UK-Canada trade negotiations or anything else you talked about.
I only got in last night. The only people I met are the people today at the lunch. I am meeting with some members of the private sector this evening and tomorrow morning. And then I'm headed home. So no, I'm not planning to meet any government officials.
Anyone else? Okay, well, thank you all for coming. That concludes our press conference today. Thank you, Governor Macklem, and thank you, everyone, and see you soon.
Pleasure. Great to be here in London. Thank you.
Thank you.